Buying options and selling options are both equally good strategies, just for different situations. But one of these strategies is surprisingly more risky than the other. So in today's video, we're going to explore that a little bit more. Buying options is often seen as gambling, and rightfully so, because whenever you're buying options, you can lose whatever you put into your trade. But there is such thing as responsible gambling. If you set aside, say, $100 a month that you can spend gambling, maybe you're buying lottery tickets, less likely to win on a lottery ticket, but if you can afford to lose that, then that is responsible gambling. But if you're racking up more and more money that you're willing to put into buying lottery tickets, then yeah, you're probably gonna go broke if you went from spending $100 a month on lottery tickets to $1,000 a month on lottery tickets.
I've got so many tickets I can't use.
The first number is 17. No!
But again, the problem here is that you can lose whatever you put in. But that's also the beauty whenever it comes to buying options, is you have a defined risk. You can only lose what you put into your trade. So going back to that $100 example, if you buy an option worth $100, you can only lose that $100. And the flip side of this, whenever it comes to the potential reward, is infinite. So you have a defined risk, but then you have an undefined potential reward if you're right on your assumption about the stock going in the direction that you chose. So if you end up buying a call option on a stock that's trading at, say, $100, and then in a couple weeks it ends up doubling to $200 for whatever reason, which seems pretty hard in this market, but it is possible, then your potential reward would be $10,000. So let's say that you bought that option for maybe only $100, and then now that option is worth $10,000 of intrinsic value. That means that you took $100 and turned it into $10,000 for a 100x return. Now, obviously, this is a hyperbole, but this is just to highlight the potential reward whenever it comes to buying options. And just like with any other strategy, you want to buy the option whenever it's cheap and hopefully sell that option whenever it becomes more expensive. We want to buy low and then sell high, and selling options is actually the same thing, except we're reversing the order. We're selling the option first, and then we're buying it back in order to close the option, if you decide to close the option. Ultimately, you don't want to have to buy the option back. You want the option to expire worthless at zero. So that means that the person that bought that option that you sold to them, you're kind of competing with that buyer and assuming that the option isn't going to have any value by the time the expiration date comes around. You're hoping that the option goes to zero.
Excuse me.
Yes, sir.
Zero.
That way you don't have to pay anything in order to close the option. So that means that you collect the full credit that you got from the person that bought that option from you. But this also means that you have a defined reward. You can only make as much credit as the buyer is willing to pay you whenever you open the option. So let's say that you got $300 in order to sell a call option, and by the time the expiration date comes around, that option is finally worthless, it expires out of the money, you only get to make $300. That is your defined reward. And on the flip side, you have an undefined risk whenever you're selling options. So this is why selling options is actually kind of more risky than buying options. But this undefined risk really pertains to naked options, so naked calls and naked puts. Because whenever you're selling naked options, you have to buy them back because you can't afford to buy or sell the 100 shares that you're trading on for that option. But whenever it comes to a covered option, such as a covered call or a cash secured put, you end up risking your collateral. And your collateral, whenever it comes to a cash secured put, is going to be your cash. So say you sell a $100 strike price cash secured put, you're risking $10,000 if that stock ends up going to zero. And then whenever you're selling covered call options, you're risking the stock going up to potentially infinity. So say you sell a $100 call, and then in a couple weeks that stock is now worth like $250. That means that you could have sold the 100 shares of the stock at $250, but 2 weeks earlier you decided to sell it at $100. Obviously, it's very hard to predict where a stock is going to be.
Nobody knows if the stock is going to go up, down, sideways, or in circles.
And this is why I like buying options more than I like selling options, because you have a defined risk whenever you're buying options and an undefined risk whenever it comes to selling options. And both of these are respectively great strategies. And it really boils down to what you want. What are your financial goals? Do you want income, or would you rather have growth? Because if you're seeking growth, then buying options is going to be the better of the two strategies. Because again, like we talked about, this has undefined potential reward, whereas selling options, you're capped at how much money that you can make. You can only make whatever the credit is. So if you're looking for income, then selling options is going to be the better of the two strategies. So buying options is more growth oriented, whereas selling options is more income oriented. But there's also other things that you need to consider, such as market conditions, because if you're buying options when everybody else is buying options, there's a lot more demand for that option, which means that you're going to be paying a higher price. So you need to look at what's known as implied volatility, or how much people think that the option is going to move. And implied volatility is determined by supply and demand. Options prices and the price of literally everything is just a product of supply and demand. So whenever implied volatility is high, that means that you're going to be paying more for an option. So maybe it'll make more sense to sell that option to everybody that wants to buy it, rather than being the buyer and paying a higher price because everybody is buying that option. Whereas when implied volatility is low for an option, then that means that there's no demand for that option, so you're one of the few buyers. And whenever there's lower demand, the prices for your options are going to be lower as well. And again, this all boils down to implied volatility. So whenever implied volatility is relatively low for an option, then it's better to be a buyer. And when implied volatility is relatively high for an option, then it's better to be a seller for that option. And implied volatility is actually very specific to the option that you're trading, because right now, at least, everybody is so focused on the short term and these new 5-day expiration dates every single week, but there's probably not a lot of people that are looking at leaps options right now, because everybody is terrified of what's going to happen over the next couple of years. So buying leaps options actually might make sense right now, because the implied volatility and the demand for that option, for leaps options, is very low. So that means you're going to be one of the few buyers buying it at a cheaper price than when everybody decides that now is a time to go long term and buy leaps. So you have to check out the market conditions. You have to consider the implied volatility of the specific option. You have to consider what is your financial goals, income or growth. And you can also swap between these. You don't always have to be a buyer. You don't always have to be a seller. It can be very specific to what you need at the time. And our financial goals are always changing. So hopefully this video was helpful. Thanks for making it all the way to the end of this video. And thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys. You want to buy high and then sell low.
Buy high, sell low.